This FourSight is about ways to trade, and most people start out, as I'm sure you know, as a sole trader. Sole trader is the business. It's not a separate entity. The sole trader is the business. They tend to have few or no employees, although that's not a hard and fast rule. Sole traders can have employees. They also tend to be below the VAT threshold, but again, that's not always true. VAT registration threshold is 83,000, and many sole traders, particularly down south, do breach that limit quite easily. The tax position is quite important to understand why you're trading as a sole trader, what you have to do. Now, tax in this country, if you're a basic rate taxpayer, is 20%. It doesn't matter whether you're a corporation, whether you're a partner, or whether you're a sole trader, you'll pay tax at 20% until you become a higher rate taxpayer. We'll worry about that later. But one of the things that most people who are sole traders don't understand is the national insurance contributions. And sole traders pay two particular national insurance contributions. That's class 2, which is a set amount per week. I think it's about £2.90 per week at the moment. But they pay that twice a year. So they actually pay it with their tax in January and July. There used to be a system whereby they paid it by direct debit every month, or they paid it quarterly on an invoice. It is now paid with the tax in January and July. On top of class 2 basic contribution, there is a further class 4 contribution, which is 9% of your profits above around £8,200. So if you earn more than £8,200, you will pay a further 9% tax on called class 4. And you'll notice 8,200 is below the personal allowance threshold. And people often get that confused. The threshold for paying national insurance is actually lower than the threshold for paying tax. It's £11,000 this year for paying tax. It's 8,226 for paying national insurance class 4. And class 4. There is an NIC upper limit. Once you get to being a higher rate taxpayer as a self-employed sole trader, you continue paying at 1%. So it gets capped at higher rate. So once you trip into 40% tax, your national insurance drops from 9% to 1%. So effectively your marginal rate of tax is 41% as a higher rate taxpayer. Perhaps you know these things. The next sort of level up from a sole trader is a partnership. Partnerships, 2 or more people working together in the same trade. A lot of people get partnerships wrong. They get them wrong because they're a sole trader, they come together for a particular project as sole traders, not realising they've created a legal partnership. And we often end up having issues with the revenue, trying to help clients to sort those issues out. For example, you might get 2 painters and decorators, each got their own business, each working independently, but they come together to paint a particular job, and they're each taking a share of the income. One is not being employed by the other, they're each operating as self-employed people. They formed a partnership for that job. And consequently, they have to fill in a partnership tax return. When you have a partnership, there are a minimum of 3 tax returns. So for a sole trader, it's 1 tax return. The sole trader is the business. The partnership, it's a separate, almost legal entity. It's not quite. I think pseudo is the price. I know, perhaps there's a technical word Ryan might use later. But a partnership is a pseudo-legal entity. It does have a life of its own. It is responsible to the revenue for reporting its profit and loss. It doesn't pay tax. Once it's reported its profit and loss on its tax return, that profit is split between the partners and goes onto their individual tax returns, which is why there's a minimum of 3. 3 partners increases it to 4, and so on. So do bear in mind that partnerships, clearly, it costs more for your accountant to do it because he's doing 3 tax returns as opposed to 1. Some people wonder why that is, but there we go. It's important to recognise as well that if you do form a partnership with people, you should have a partnership agreement. We don't do partnership agreements, see right, it's a legal thing. We tell our clients they need them. We nag our clients to get them because it's the what-ifs. And the what-ifs, you die, you've left your share of business to your partners, to your wife, and your business partner's now got a brand new partner he may hate and detest. What happens if you want to get out of that partnership? What happens if you want to bring somebody else into it? You need a partnership agreement to sort out these what-ifs. They're critical. I actually had a partnership that was formed some years ago. 2 guys that worked together decided to form a partnership. I nagged them about getting the partnership agreement. About 8 months into the partnership, they went along and saw a solicitor finally, sat down with the solicitor, agreed all the terms and conditions, and both walked out of the meeting and said, do you know what, I don't want to be in this partnership anymore. And it broke up within the first year. So it's actually a very valid exercise from that point of view. So it does have more than just the what is. The tax position for a partner is exactly the same as a sole trader. You have a legal tax return for the partnership, you've then got your own sole trader tax return, and you're taxed in exactly the same way as a sole trader. So it's class 2 and class 4 national insurance, and same tax. There's a next step up from a partnership, which is the limited liability partnership. Now, these do still exist. They were actually invented, I think, in the 70s, created in the 70s, basically for use by professionals. I think solicitors are now allowed to trade with limited companies, but in those days they weren't. Barristers particularly, I think, was a problem for them. And their accountants weren't allowed to trade as limited companies either. So limited liability partnerships came out, which is a halfway house between a partnership and incorporation. There's still a place in the world for limited liability partnerships, I'm sure. I've just never found it myself. We don't have any in our books. And when people have come along and looked at it, and we've gone through the details, they've either incorporated or worked as partners. But I'm sure there's still a place for them. So a limited liability partnership is registered with Companies House as if it was a company. It is governed by Companies House regulations as well as HMRC, so it's got double jeopardy. And it fills in an annual partners report and accounts. It's equivalent to the annual director's report and accounts. It's in exactly the same format. The only difference is when we move on to the taxation side, it's taxed as a partnership. And so the individuals that make up the limited liability partnership are taxed as sole traders, unless one of the partners happens to be a corporate body. And I should have mentioned, a partnership can actually have a corporate body as a member of that partnership as well. So, although I said they are taxed as sole traders, if there's a corporate body that's a member of a partnership, it is taxed under corporation tax rules. It depends on the individual partners how they're taxed. The limited liability partnership, being that halfway house, does offer people the sort of regulation and credibility of being incorporated without being incorporated, and then offers them the advantages stroke disadvantages of being taxed as a sole trader. And there are ups and downs on both sides. The final form of trading, of course, is as a limited company. Incorporation, there are several ways of being incorporated. We don't tend to deal with limited companies guaranteed by, limited companies are not shareholders, they're guaranteed. How do they call it? Limited company by guarantee. They are generally charities. They have to exist because they're usually collecting community money. So you might have a school, for example, for educationally subnormal people that will give these people a trade, and they'll teach them to be bricklayers and plumbers and electricians, etc. And they get government funding to do that. So obviously the government says, we need to have you operating as a limited company by a guarantee, not by shares, in order to have a governing body. They don't have a board of directors, they have a governing body. And the governing body isn't necessarily made up of people who are within that business. So you might have a local police inspector from the town might be on your board of governing bodies. You might have a local vicar from the local church on it as well. So people are going to look after the interests of the community for whom this limited company by guarantee is protecting. If you wind up a company formed by guarantee, you don't distribute the assets. Those have to be transferred to another company doing the same thing. So there is no distribution to anybody that's involved in it. I have occasionally had a client come along and said, I want to form one of these companies, this is what I'm going to do, and we've talked them out of it. Because at the end of the day, they lose control of what they're doing. If they decide to stop trading, any assets that are left in that business belong to another company and have to be by law transferred to another company. So they exist, they're there for a very good reason. One everybody is normally used to, of course, is guaranteed by share, is limited by shares. So you form a company with shares, one share being the absolute minimum you can have, and obviously you can only have one shareholder, or you can have two people that own that one share. One of them is the lead shareholder. If you want more shares, you can simply do that at formation. It's much better to create the number of shares you want on formation than ever it is later down the road. It's much easier to do that. So if you know you're going to have 4 shareholders and you want them all to be equal, get 4 shares. You don't need 4,000, you don't need 4 million. There's a very good reason for that. However many shares you have, you're expected to put that money into the business. So if you form a company with £1 share, that's all you've got to put in. If you form it with 100,000 shares, should that company fold and you didn't put the 100,000 pounds in, The liquidator is going to come after you for your £100,000. So it's important to get those things right from the beginning. Okay, limited liability partnerships we talked about earlier, taxed as sole traders. Limited companies are taxed as corporations paying corporation tax. There is no national insurance payable by the limited company on its profits. However, if you take a single person limited company with one share in that business, then you have to look at the whole situation of the single owner and the limited company as one entity and consider how they take their money out. Most of our, up till April of this year, it was a completely different regime, and single directors of companies would pay themselves just below the national insurance class 1 threshold of £8,226. You've heard that number before. There's a little band. If you're in that little band, it's £15 below that threshold. You get all the rights and benefits as if you'd paid class 1 national insurance without paying a penny. It's very tax efficient. You earn pension rights, you earn any other disability rights, etc. But you don't pay for them. And so you can save yourself to 26% that class 1 national insurance is. So look at the whole thing. Employees pay 12%, the employer pays 14%. Those are rounded numbers, it's 11 point something, 13.8. 26% is the national insurance that an employee will have paid for them. So you can see why national insurance is something that the sole traders will not want to go into the incorporation for. They're only paying 9% versus 26%. It's also important to recognise that the revenue aren't interested in your tax position, because tax is tax is tax and the thresholds tend to be the same, but they're very interested in whether you're actually employed or whether you're actually self-employed. That's a critical factor, because if you imagine you're working as a self-employed person paying 9% tax, the revenue are losing out on 16-17% of national insurance, and that's a big hit. That can be an awful lot of money. Imagine you're earning £100,000 in your limited company and you're operating as a sole trader instead, paying 9%, the revenue are losing 17 grand out of your 100,000. It's a big tax. So getting the right way of trading is absolutely critical to making sure you're paying the minimum tax legally. But the revenue have a little thing called an employment indicator status tool. If you go on the Revenue's homepage and look for tools and calculators, you can get through to the EIS and you can check whether or not you are an employee or whether or not people who are working for you are employees. You do have to answer the questions honestly. If you don't answer them honestly and the revenue come and question it and you say, well, it's not quite like that, then you can't rely on it. But if you get to the end and it says there's a high indication this person is self-employed, you can print that off and rely upon it if you're inquired into. As long as you've answered the questions honestly. If you haven't answered the questions honestly, you're in trouble because you've got an incorrect answer. And if it comes back and says there's a high indication this person is an employee, get them on class 1 national insurance and pay the NI, because the penalties are very, very punitive. As you know, if you underpay the revenue for anything and they inquire into your affairs and determine there's a shortfall of tax, you have to pay the tax and there's always a penalty. You will never pay less than 10%, and the 10% is if you can really come up with some good mitigating circumstances. You're more likely to be, well, it can go up to 100%. So if you imagine that £17,000 been going on for 3 years, you're £54,000 out of pocket, aren't you, if the revenue come along, because they will take it back. And they'll then add the fine, which could be as much as another 54,000. It will be lower, but it could be as much as that. So it's important to get these things right. So if you're ever in a position of either not sure of your status or not sure of the status of someone who's working for you, get it checked, because it can be so onerous, particularly with the penalties. And the revenue never come along in year 1. If you get it wrong in year 1 of trading or year 1 of having an employee, the revenue never come along in year 1. It's always usually year 3 or 4, because then they get whacking great fines off you. Most people, I think, if they've got that kind of fine, would probably fold the business, because it's a life-changing amount of money, isn't it? So it's important to get it right at the beginning. Pay as you go. Quick check on where we're going. Yes, I did mention earlier on with the LLPs that you're bound by companies' house rules as well as HMRC. Same applies to obviously normal limited companies and companies limited by guarantee. If you're late submitting anything to HM Revenue and Customs, there could be a penalty. It's often a straight £100, depends what it is you're late with. It can be a percentage of any tax, for example VAT, if you're late submitting that, and that can be very punitive. I was looking at clients' books recently where they had £90,000 worth of overheads in their last year 6-month figures. £22,000 of that was the fine from Ancient Revenue Customs for being late with their VAT return. So that's a third of their overheads for running their business. That's a punitive figure, isn't it? So be aware of these things. So HMRC have deadlines. You miss them, you get fined. Companies House is a government organisation, and they love fining you as well. And their fines are also quite punitive. If you are a month late, for example, filing your accounts at the end of the year, then you will be fined £150. Unless you've done it last year as well, in which case it's automatically doubled to £300. If you go past a month, it becomes then on the 3-month section and you're now into £350, unless you missed it last year, in which case you're looking at £700. You see how these things rack up. And you'll be amazed how many clients actually miss it because they don't pay attention to their affairs. I'm thinking of changing my terms and conditions to have a little statement in there that says you're not outsourcing your responsibility or your liability, you're outsourcing the work. You've got to maintain responsibility and liability. Lots of self-employed people and clients actually don't think that way. Think, oh, I'm giving it to the accountant, I can forget it. No, you can't. Because it costs you money, not me. Important thing to point out. If you forget to file your annual return, and if you don't file your accounts for long enough, eventually Companies House will strike that company off. It's not something you want to happen, because if there are any assets within that company, they now belong to the Crown. So if there's a bank account, it's got any money in it, that company gets struck off. And unless you're on the ball, you may not know it's happening. So if you don't know it's happening, you should, but you may not. You could discover that your business ceased to exist yesterday, there's some money in the bank account, that's now frozen. It belongs to the Crown. There may be other assets in the business, whether they'll come and collect them or not depends on the official receiver, but technically they belong to the Crown. So it's important to get those things right. Corporations are taxed at 20%. If the sole owner, which is how a lot of us trade, are paying themselves at the Class 1 National Insurance, up until April of this year, you could take dividends up to approximately £40,000 of the total income before you became a higher rate taxpayer, and there was no more tax to pay on that distribution of profits. So you could take £8,000 out per year without paying Class 1 National Insurance. You could then take dividends of approximately £32,000. Yes, 20% tax has been paid on that by the limited company, but it's capped at that. There's no further tax payable. That changed on April the 6th this year, and they brought in a dividend tax rule change. You can now take £5,000 out of distributable reserves without paying any further tax. Any dividends beyond that are taxed at 7.5% for up to the higher rate tax limit. And this is where it really got punitive. If you kicked into higher rate previously, you'd pay an additional 22.5%. Now it's 32.5%. And the highest rate of dividend tax is 37.5%. So it can be quite punitive operating that way. And in fact, some people have now gone back into Class 1 National Insurance. Some of our clients have said, I'm not wasting my time hanging on for dividends to be released to me. I'll pay the Class 1 National Insurance every month, so I'm going to have a proper salary. It has had that effect. Thank you very much. That's quite a lot of information, quite a lot of numbers. Are there any questions?
Yes.
Well, so you're the tax guru.
Yeah, well, for the benefit of others, really. Yeah. Just touch on why you make payments on account. So you said about talking about paying tax in January and July. A lot of people get confused about some of that tax.
There's a thing employees do called pay as you earn, and it's up to your employer. He has a legal obligation to tax you through the PAYE scheme and hand that money over to the revenue. As a self-employed person, you're outside of the PAYE system. Consequently, you have to account to the revenue for your tax affairs, called self-assessment. Self-assessment demand is that you will submit a tax return by the 31st of January for any self-employment that took place in the year ending the previous 5th of April. So if we look at the current year, if you started business today, by the 5th of April you'll have done some self-employment in this current tax year, you will have to submit a self-assessment tax return in January 2018. At that point you pay the tax. You pay the tax on that profit of that 6-month period, plus half as much again. So it's a payment on account for the year ended 5th of April 2018. In July 2018, you will pay half as much again, which should be the balancing figure, isn't always, but that means you've now paid 150% in January, plus 50% in July, you've paid 200% of your tax in that 6-month period, so you've caught up the fact you haven't paid any tax from now until the end of January 2018. So what's that, 18 months away, something like that, 15 months maybe. But you don't pay tax all that time, and then suddenly you hit it. And after that, it's every 6 months. January is half as much, again, of your tax from the previous year, plus any balancing charge. Sometimes it's a balancing credit, you get some money back. In July, it's just 50%. So a sole trader will pay twice a year. As an employee, pays once every week or once every month, depending on how often they're paying. Okay?